I noticed earlier in the day that we were told that today is yesterday's tomorrow. You began by saying that today is the tomorrow of yesterday. In the words of that famous economist, James Bond, tomorrow never comes. Ladies and gentlemen, would you please welcome to the stage our panellists. From the far end, Cheryl Parker-Rose, Assistant Director, Office of Intergovernmental Affairs, Consumer Financial Protection Bureau from the United States. Welcome. Next to her, prominent New Zealand economist, Shamubeel Eaqub. Coming along in the very colourful scarf, Maria Lucia Leitao, the head of the Conduct Supervision Department from the Bank of Portugal, and, closest to me, Johnny Noe Ravalo, Assistant Governor, Financial Supervision Research and Consumer Protection Subsector from the Bank of the Philippines. Welcome to you all. Thank you for being here. Our introduction to this session is as follows. As opportunities arise from the growth of FinTech, what is being done to handle the challenges it brings, including rapid access to online credit and innovations such as peer-to-peer platforms that Subhash illuminated? And also, what steps can be taken to educate and protect the more vulnerable consumers in an increasingly digitalised world? Those of you who have read the programs will recognise those very words. I want to begin by asking each speaker to briefly describe the state of play of FinTech in your respective countries, how it's increasing access to financial services, and whether this will improve people's prospects in the future. And take a couple of minutes to address those questions. And I'm going to begin with the courtesy of the tyranny of distance and go from the furthest geographical representatives, which would be Maria Lucia Leitao, please.
Okay, good morning to all of you. It's my pleasure to be here and share my thoughts on this issue. It's an issue I've been following very closely because it's a big challenge. I have obviously to speak as a central banker. I'm a regulator and a supervisor, although obviously I'm also a financial literacy advocate. And we think that FinConnect, as it was said before, is nothing new. But the pace of growth of innovative technology linked with financial services and some kind of innovations, they are putting lots of question marks and challenges for us as regulators and supervisors. We think it's very, very important not to forget, not to be behind the curve in terms of innovation. We need to work hard to I have to acknowledge before, to understand the digital per se, and then to think of the challenges that it may bring to us as regulator supervisors, because we need to be ready to help those customers that are going to be involved with these new digital financial services to learn to take precautionary procedures, because security is one of the big challenges, one of the new challenges we are facing now. And obviously, they need not only to take those precautionary procedures, but they need also to be aware when they go and try to get a credit that it will be very easy with a finger touch to get the credit, but they need to understand the long-term commitment maybe they are taking and all the implications. This is a quite new world in terms of the speed. And let me emphasize one thing was mentioned this morning, and it's very important. We have millennials, but we have also the digital natives. And those guys, if I can use this expression, they will not go to a branch. They will start using these financial services through their mobile. They will not learn. I'm not sure if they will touch coins or banknotes. I think they will touch only the mobile.
I'm not sure if they leave home. Thank you very much, Maria Lucia. Cheryl Parker-Rose.
So let me first start by saying that the Bureau, or the CFPB, we actually have two mandates. The first mandate is one where we are mandated to protect consumers. But at the same time, we have a mandate to facilitate the innovation of financial products and services. And we take both mandates very seriously. However, it is incumbent upon us to make sure that we balance that approach. Some of you in the audience, because we've done a great deal of work with several of the international regulators around the FinTech issue, we actually created, in 2012, we created a new office called Project Catalyst. And the purpose of Project Catalyst is to facilitate marketplace innovation so that new and emerging financial products are safe and beneficial to the consumer. And through this initiative, we are gaining research insights from industry pilots. We're creating policies to promote consumer-friendly innovation. And I think most importantly, we're hearing directly from FinTech companies. But let me also say that while that work has been steady and consistent, the reality is, to date, we have not made any policy decisions about our work with FinTech companies. We believe that we have the authorization to actually regulate those companies, but today we are still doing a great deal of research in the area.
Thank you very much. Johnny Noe Ravalo.
Well, good morning to everyone. From the standpoint of the Central Bank of the Philippines, certainly consumer protection, financial technology, it's all on the radar screen. But let me step back for a while. When I did my college thesis, I had to punch holes on cards for the computers to read them. When I got to grad school in the States, there was no card catalog. I had to learn how to search by a computer, which was very difficult for somebody who was so used to pieces of paper. But today, my children refuse to read anything outside the tablet. So as a parent, I could see and I could feel the difference between, well, aside from making me feel really old, I could see the difference between my time versus that of the generation today. But I'd like to make the point that I'd like to think that it's called FinTech for a reason rather than tech cum fin. In other words, we need to focus on the finance part of it. The technology will be there. It will evolve. And we do have technology specialists to worry about that. But at the end of the day, the issues that we're really talking about has to go back to finance. What about savings, retirement, consumer protection, and that the technology becomes the means and the medium to it. Yes, the message is changed, the delivery is changed, but it's still finance.
Focus on the right part of the question. Shamubeel, Eaqub.
Thank you. It's hard being the last one because they've all said it all. But I think the common theme was very much around that the technology aspect is making the change really fast. And the big question is around whether the regulatory framework is keeping pace with the change that we're seeing. From the perspective of New Zealand, and as an independent economist, and in fact an unemployed economist at the moment, my perspective is probably as independent as it gets. And the reason I mention that is because when I look from the outside, I think what I see is essentially a huge amount of opportunity for New Zealand. When I look at New Zealand, what I see is a country that is extraordinarily affluent, but we have a financial sector that is quite frankly pathetic. Whether we see it in terms of size, sophistication, or efficiency, there is huge amounts of improvement that's possible. And with FinTech, I think the big potential that's possible is really around that global access, that introduction of competition, the bringing forward of best practice that will drive down both costs, variety, and our ability to grow the market significantly. We know that the central government here has a stated policy of supporting FinTech, but we don't know what it means in terms of the practical steps we would take in terms of changing our institutional structures, both to find the balance that you were talking about in terms of consumer protection at the same time as allowing that innovation to happen and in fact encouraging that innovation because we want to support the growth of our economy and growth of our financial sector. And ultimately, I think what I see is the FinTech changes that we're seeing is part of, as everybody has said, part of that evolution of finance more generally. But what's really important is we know that there are some serious risks in terms of both for consumers, in terms of the changes being so fast that consumers don't have the financial literacy to be able to manage those risks. And we've seen that in New Zealand in some cases in terms of access to consumer credit through P2P lending facilities. But at the same time, I know of personally many financial fintech companies which are finding it very difficult to navigate the regulatory process to get started, even though you can see that that particular technology or the particular application would have significant benefits in terms of freeing up the movement of capital and essentially be part of the transition that we're talking about. So New Zealand to me is in a very interesting place where I can see the case for accepting and encouraging the fintech that we're seeing flourishing globally, but very much in its infancy. At the same time, I see regulation generally being backward-looking and slow, as it is everywhere. And the difficulty is that the technology is moving so fast, I don't think we can wait for the technologies to just come to us. We have to be far more proactive. The Financial Markets Authority in New Zealand is trying to do that, but the reality is that for bureaucracies to do that well is really, really hard. So massive opportunities, I think we must accept it, we must grasp the mantle, but I can see all these issues, but the main focus is very much around the role of central government in being both the usher in terms of helping the financial sector grow, but also being a bouncer of a sufficient quality to be able to protect our consumers from the risks that we see.
Thank you all very much. Diane, did we have a video that we were going to run, or just at the top, I think it might have shown some fintech opportunities. I thought it might be a good time. Okay.
The fintech revolution is changing the way we interact with money and meeting different needs in different countries. Kenya has led the world in mobile money.
Technology in the mobile phone is having a profound impact on the way people do things in Africa. People can deposit and withdraw, transfer money to anyone in Kenya. That is an enormous convenience. Many Kenyans don't have a bank account. The majority do not have credit cards, and they live in rural, remote places where getting to a bank is difficult.
While in India, mobile phones are getting pensions paid on time.
हमारे यहाँ जिले में 28 गांव में पेंशन बांट रहे हैं
और अब ऐसी है कि टाइम पर मिलती है, प्रत्येक महीने मिल जाती, पहले डिले भी हो जाती थी, अब सही टाइम पर पेंशन मिलती है.
And back here, Sorted is helping people plan their financial future anytime, anywhere.
Sorted.org.nz helps us Kiwis get all our money matters sorted with easy-to-use tools, calculators and info to put us in control. On our phone, tablet or computer. So sign up now at sorted.org.nz. It's totally free and see how easy it is to get your money sorted.
So there we have several examples of how fintech is allowing consumers around the world to benefit, to change their lives, hopefully for the better. I'd like you to expand on this, and I'm going to encourage you all to treat this as more dinner party conversation than a group interview. So feel free to expand and add on to each other. In the big picture, how are consumers benefiting, with further examples? Cheryl, would you like to pick that one up?
Before I answer that, I'd like to get back to the comment that you were making earlier. One thing that we've learned, so we have several different tools that we use with the various fintech companies. In addition to actually engaging with them on a one-on-one basis, that's an opportunity where they sit and talk with us about that regulatory landscape. One of the things that we found is, and I say this openly as a regulator, oftentimes regulation can often discourage innovation. We want to make sure that that doesn't happen. So we have a program which we refer to as office hours. Those office hours take place in the major financial hubs of the United States, New York, San Francisco, and recently we held a couple of office hours in Houston, Texas. So what we found is these fintech entrepreneurs come in and they talk with the Bureau about what they are planning on doing. We're not giving them advisory opinions, but rather we are explaining to them what the regulatory regime actually looks like. So we have found that to be hopefully useful to the fintech entrepreneurs, but it's been extraordinarily useful to us as we think about future regulatory policies that we might put in place. I think I said earlier that in reality, while we are engaging fairly robustly with FinTech companies, we actually have not implemented any policies related to that. So what I'd like to do is spend a few minutes talking with you about an initiative that we really just announced the results a few days ago, about an initiative that we entered into with American Express. And I offer that in the spirit of Ida's mantra: in order to get to later, we have to think about now. So what happened was Project Catalyst did a research pilot with American Express to support our efforts to better understand how, why, and promote savings among individuals with low and moderate incomes. And American Express used several different mechanisms to encourage people to actually save. In some instances, what they did was they actually sent them email messages, they sent them direct mailings, and they offered a $10 financial incentive. This was done through a prepaid card. So the idea was that they would get $10 as an incentive for meeting a savings goal of $150 within the 3-month period of the pilot program. And we actually ended up with some very significant results. Number one, the uptake in the savings wallet more than doubled with the financial incentive. Simple methods of encouraging consumers to set aside funds for the prepaid card drove consumers to take action. When the company offered the $10 savings incentive, it actually increased twofold. The consumers in the test group all decided that they wanted to save. And we're not talking about a small class. We're talking about over 500,000 consumers who participated in this test pilot that American Express did. The second finding was the savings continued even after the 3-month period ended. So while the pilot lasted for 3 months, we actually tracked the savings habits of those participants for an additional 9 months. So during the 3 months period, the average savings amount was $150. 9 months later, the maximum savings amount was $100. So that's pretty significant. And then finally, we found that those consumers participating in the test pilot, their use of small dollar loans, or in the US, as we often say, payday loans, that decreased significantly. In the US, payday loans are often annualized at 300 to 500%, so this was quite significant. And if I could just take one other liberty, we are in the process of regulating payday loans right now. We put out a notice of our intent to regulate the payday industry. That comment period closed last Friday. We believe at the end of the day, we would have received over 1 million comments related to the regulation of payday loans. I know that some of you are members of FinConnect. I believe that FinConnect's has taken on small dollar lending as one of their major projects, and we would be happy to share any of our findings or comments that we received from the public around our payday rulemaking.
Cheryl.
That was a very long-winded, but I did want to share the results.
I might not get back to you again.
That was my aim.
Maria, please.
I think it's important to refer to the following. And take into consideration the video we just saw. When we refer to fintechs, we refer to new services, that's for sure. But we refer also to very well-known plain vanilla services, financial service being provided through digital channels. We also refer to new providers, but we also refer to incumbents that are taking the lead. They are trying also to compete with these providers. Some of them in certain countries, I would say maybe probably most of countries, out of the scope of the supervisory authority. In Europe, we tend to have a very comprehensive regulatory approach to all these new providers. If you think of payments, we have important set of rules, and we are going to have a very important one beginning of 2018 that will put inside the supervisory perimeter the initiators and aggregators of payments. Because what we are having now, it's a new kind of financial model when we look at digital banks, they offer a set of services. Some of them are completely bundled. But at the same time, as we discussed yesterday during the INFI gathering, some of them are also nicely offering some management tools. Then it's a new world. It's a very complex world. And as it was said before, we need, as regulators and supervisors, as regulators, we need to think and not to be behind the curve. As supervisors, we need to reassess our oversight tools. And we need to try to balance if the consumer protection framework we have is the most convenient one. Because in order to allow this, and we cannot prevent, we want innovation to go ahead, but we want innovation without jeopardizing financial consumer protection. Then there is need for regulation, there is need for supervision, there is need for financial literacy. And the examples were given, we have much more. In Portugal is the incumbents that were leading financial innovation, okay? We have outstanding, if I may say so, ATM system, outstanding, because it's very innovative. We can do everything through ATM. We can pay bills, we can recharge our mobiles, and it's there since '85. In 2001, they were the first to introduce virtual cards. I can go to the ATM and create a virtual card. Now I can go to the ATM and download or have access to download the app, and I can use my mobile to pay when I go to a merchant. Plus, it's for free. Customers do not pay when they go to an ATM or when they go to a POS. They do not pay anything, and the coverage, I'd say it's the largest coverage we have. They are there. They are working hard to also keep pace with financial innovation, because FinTech is there. It's not only providers, our services as well. It's very important, in my perspective, if you allow me, to have a more comprehensive approach, not to think of one precise service. Obviously, it was very innovative, and it is maybe not very innovative, but we need to consider it as inside of our scope and inside the thinking of the features and the advantages it brings to consumers, the risks it also may bring to consumers, and to work together with them.
It's a very comprehensive approach, and thank you both. We have the American and European perspectives, Johnny. From a Philippine perspective in Southeast Asia.
Well, the challenge has always been, where do you draw the line in the sand? Financial technology will obviously provide something new. If you're shifting from paper-based to a digital delivery, digital packaging, it will always be new. The challenge for us regulators is, at what point do you let go and let technology drive the market? And at what point do you care for consumers who may not know enough? We are getting complaints that after 5 months of use of credit card, she claims that she didn't know she had to pay for it. So, and the complainant brings along a TV crew, so you know the bank will be cited in the evening news, and it's my job to call the president and say, just to let you know, you'll be in the evening news. The balance is 7,000 pesos, which is a little over $100. I don't know how much your reputation costs, but I let you decide. The problem there is, then the TV crew will announce, it's our intervention that got her off the hook. And therefore, the next complaint comes in with another TV crew. And it goes on and on and on. So where do you exactly draw the line that allows you to nurture the creativity of providers, whereas providing for enough buffer for the users? And that's where Maria's point about consumer protection, financial literacy, in an archipelago where there are over 16,000 municipalities with very distinct social, cultural backgrounds. It's going to be it cannot be an off-the-shelf thing, and that's one point. The other point, if I may just quickly jump in on the point about Cheryl, it's very important that we go evidence-based with respect to how much technology is making a difference. But here is where my nerdiness as an economist comes in. If you're going to test a population that already saves and then introduce technology and they save more, it could mean everything or it could mean nothing because time evolves. What about a population that does not save? And if you introduce the technology, will they save? What about families that are broken apart because one part, the Philippines, you cannot drive from north to south. You either have to learn with the shark, to swim with the sharks or ride a boat. So if families are fragmented by the nature of their work, how then do you build up a concept of family saving I was thinking about the reference made by the deputy governor, the lady of the house type of thing. So there will be unique challenges on the financial side, and technology adds another layer of complications. But I would certainly hope we don't forget the core layer, which is still saving, finance, retirement, making sure you have enough funds for a rainy day, don't go over indebted, and don't succumb to fraud.
I want to come back to that delicate balancing act that you as regulators particularly face, and I'll go to the non-regulator on the panel to answer the question. If you have the demand and need for innovation to provide products that are beneficial to consumers, you're therefore going to get developers who are creative and a different mindset to regulators who are generally preventative more than anything else. Do they need to stay in lockstep, or are regulators going to have to simply play catch-up the whole time, Shamubeel?
I think we're seeing two different approaches. So for example, in the UK, they have taken a very active approach to say we are going to encourage and embrace financial innovation. So they're really championing things like blockchain technology, and they want to be the center of that innovation. And whether or not they succeed is entirely different to the approach the government may want to take. In the case of New Zealand, I think what we're seeing is regulators are trying to be as involved without interfering too much. But the complication is not so much around the intent of the regulator, but the fact that we might have 3, 4, 6 bits of different policies that might affect these new types of companies that actually go across more than one industry. And so what happens more often than not is that the regulator itself may not know that these new technologies might be impinging on other regulatory barriers that they haven't thought of. And this is very much a learning process, and it's very much around whether or not the regulator, it's very much around the philosophy of the regulator in terms of where they go. So far, we're seeing a fairly accommodative approach from regulators because, like you said, we don't want to regulate too early to kill off the new ideas, but at the same time, we want to make sure we're watching them closely and keeping them in the tent so that we're not opening up our customers and our consumers to harm. Very delicate balance, but right now, I don't know exactly which way it's going to go.
You need to stimulate the growth, don't you? But you can't restrict the development at the same time.
It's lockstep.
It is lockstep. You can't just let the innovators run, then the regulators play catch-up, which is traditionally the way that many governments operate.
But the disruption can be challenging in that it can lead to bad outcomes. And quite often, then what happens is the regulation moves too far in terms of being so restrictive, then it stops the innovation and stymies an entire sector.
But even within the central bank, I think there is that natural debate between the tech side and the consumer protection side. If we write a law that says you can't distribute pre-approved cards because people will just basically misuse them, and then what if 3-4 months down the road, the tech guys elevate a memo to the board saying, if the technology firm or bank meets a certain level of technology, then they can distribute pre-approved cards. Is that good or bad? Does that help? That from a technology standpoint, yes, they meet the new standard, but from my consumer protection standard, how do I then go to the press and say, by the way, you're not, please tell the public, the public is not supposed to accept pre-approved cards and then mumble the exception. Because there will be an exception, right?
Always.
Johnny, I don't disagree with you, and I don't think you're saying this, so I'm asking for clarification. As the regulator, and we are both regulator and supervisor, unlike the central bank who's primarily focused on safety and soundness matters. But as the regulator, I think what you don't want is to create this false sense that you have to choose one between the other. And in that way, I think across the globe, there are regulators that are trying to straddle that line. They are both trying to encourage the development and use of innovative products, but at the same time, without drawing a line in the sand, saying if you are going to develop these products, these are some of the mechanisms that we think are policies you must put in place to protect the most vulnerable consumers. And to your point, how do you really measure the behavior of a group of consumers who are already saving? I think the standard should be how will this product affect the most vulnerable of consumers, the least financially educated financially literate of the consumers. For the Bureau, that's our standard.
I agree with Cheryl, just on a quick point. The challenge for us as a banking regulator supervisor is many of the FinTech companies are not under our purview legally. So that's where you have to create standards. Therefore, the challenge is the standard tech or is the standard consumer protection? My problem with consumer protection, that means I'm one step behind. I will be preventative, using the term for Simon, rather than proactive. We'd like to be proactive through financial literacy, and we do the road shows and stuff, but there are also limits to the resources to be able to do that.
Absolutely.
May I ask one question? Can regulators prevent financial innovation completely? We have to take into consideration that we have Uber all around. We have a problem in Portugal these days because Uber came all of a sudden. Our taxi drivers are fighting, and government is trying to balance the approach of those two parties. I think as a regulator, we have to take into consideration that financial innovation is global. Obviously, we have our room of maneuver, and I think the most important point is to define if all those players should be or not under the scope of the regulatory authority or the supervisory authority. That definition is very important, because if we consider that all of them, obviously, we can think if they are in a process that is going through the creative, I would say, innovative process like UK with regulatory sandbox and so on and so forth, you can think that maybe it's not yet time. As I said, in Europe, we have initiators and aggregators. They are not yet under the regulatory supervisory authorities because, as I said, they will be only from beginning of 2018. But as I was trying to emphasize, it's very important to think if you want to have those providers, it's a political decision, okay? Obviously, for countries that have that autonomy, obviously in Europe it's a more common approach, or not. And then we have to analyze the products per se. As a regulator now, as the banks are fighting for digital channels and new products, I'm going to exaggerate, but I have banks queuing to have a meeting with me to explain the new digital procedures or the new product they are going to sell, and asking for my permission to allow them to go and, for instance, to sell credit cards through iPads. And I have to discuss with them how they are, with that approach, fulfilling disclosure requirements as the others have to do when selling those products over the counter. It's a very comprehensive approach, but I think one of the most important decisions from political side, from supervisory regulatory authorities, is to define if they have to be in or out. Yes. Apart from that, there is obviously a discussion on momentum to include them in or not, and then we can discuss with them the kind of products they are selling.
I think you've all defined very well the conundrum that you're facing, the wrestling, the balancing act between regulation to protect the most vulnerable and innovation to encourage financial products that are beneficial to consumers. Political questions, legal questions, all there, the whole framework. I want to take you in a whole different direction though. Blue sky approach. Where do financial tech product development lead us? What are the possibilities and how beneficial can they be to consumers ultimately? Do you want to have a go at that one, Shamubeel?
Yeah, I guess for me, it's really around the heart of what economic growth is about. What we're seeing in terms of FinTech is the evolution of productivity gains of innovation more generally. And I think that's what we've been talking about is this innovation will happen but the consequences of that is making it, generally it's making it easier for consumers to access credit, making it easier for them to do payments, it's making it easier for us to do lots of different things. The question becomes then really around the extreme points. If you're going into a place where it's unsustainable in terms of bad outcomes, that's really where the regulatory interface comes in. From a macroeconomic perspective, I would argue that what we're seeing in terms of the development of financial technology sector is extraordinarily positive, because not only are we seeing this constant evolution of productivity gains in the financial sector, we're also seeing this inclusion of technology into these old industries. Finance is very old, and it's that innovation, that renewal, the regeneration of the economic activity, which is extraordinarily exciting. And like anything with economic activity, when you've got growth, you've got at the margin risk that some of those innovations might not all be positive.
The question is how margin is margin. When your literacy survey tells you that the general population cannot answer half of a standard test,
sure,
I think the margin is larger than the fringes. And in that sense, our approach has always been to emphasize the financial literacy part as a proactive means, use the complaints mechanism as my reactive means. In other words, I will learn from the complaints and see what's working, what's not working, and then talk to the tech guys and tell them, look, this is what I get from the public. Maybe we can calibrate. So it's a question of calibration, I think.
But I would argue that we've been talking a lot about financial literacy for many, many, many decades, and the progress has been extraordinarily slow. And this is why regulation is so important, to make sure consumer protection is the heart of things. Yes, that's a worthy goal, but it's hard to do. And humans are just designed terribly to do the kinds of things that are good for us in the long term. We know this. So this is why I guess that consumer protection thing, the outcomes-based thing that all of you have talked about, that regardless of who's doing that product, if it's within the outcome of you engaging in kind of financial services and it has the potential for harm, then it should surely come under the regulatory gambit of whoever is doing the regulation in that country. But at the same time, we know that innovation will happen regardless. Whether you want it or not as a regulator, you will have to pay a catch-up. And the only thing that it tells me is that the innovation that we're seeing is giving us economic gains in terms of visible activity, in terms of new jobs, new types of jobs, and those kinds of things. But it creates a greater urgency for regulators to be far more fast-moving, far more nimble and agile than they have been before. It's forcing them to be so. But I agree with you. The difference in terms of the cost versus benefits, they're probably not that far apart, but they're in different places. The benefits are in one part of the economy and the costs are in a different part of the economy. Your point is around the vulnerable people, the people at the most vulnerable end of the community who are going to bear the cost of the mistakes, whereas the benefits, by and large, will be accruing to the entrepreneurs and the financiers and the venture capitalists and the people who have highly skilled jobs. So there is this inequality that underpins a lot of this conversation. We haven't gone there, but it is around that broader change that we're seeing in society because of changes in technology, which is about polarization of jobs, of opportunities, and the future of work, and the role of regulators to find that balance to create the protections at the boundaries.
May I emphasize the importance of financial literacy? Again, I think it's very, very important. But it's not enough. Financial literacy has to be a strategy for the medium term. Obviously, when we start with initiatives with young people, maybe the outcome, the results will be faster. And I very much, as I said before, I'm very much in favor of financial literacy, but I think, as I said also before, it's very important to have a very good regulatory approach. And it's also important, and I was now remembering you mentioning FinConnect. FinConnect had a standing committee preparing a report on acknowledging more and more the importance of online and mobile payments. As being analyzed, the supervisory challenges mainly relate with security. I was honored to be the chair of that standing committee. The report was released 2 weeks ago, I think. And one of the main, outcomes of that reflection we had was to call attention of banking, conduct of business supervisors, that they cannot forget that digital payments is an issue also for them, not only for prudential supervisors, not only for payment overseers. And if you can call the attention of those supervisors, I'm mentioning banking, in this case, banking conduct supervisors, that they need to look at the challenges these payment services, and now I'm referring only to payment service, but it applies the same for credit. They have to acknowledge that there is a new challenges, and they need to look at those challenges. You may say, no, but it's pretty clear they should be aware. It's not that yet. I would think that in what refers to payment services, some of my colleagues all around the world, some of them think, oh, payments, it's for payments overseas. It's nothing with us. But it is, because more and more payments are being sold through apps, wallets, bundled, as I said before. People do not know which kind of payment services they are using quite often, because the payment service is identified by the name of the provider. Quite often, they can have a wallet linked with a debit card or credit card or current account. Do they think twice when using using a debit or a credit card? You see what I mean? It's a much complex topic, and I would say regulators and supervisors cannot forget that they have a say. They need to take them on their agenda, at the top of their agenda. That's my message.
So you're not just controlling innovators, are you? You're actually following cultural trends and social change. The internet, the cyber world has developed a new marginalized class, if you like, of people who are left behind. Is the development of FinTech also contributing to a new vulnerable? Anyone?
Well, we have great examples in New Zealand where bank branches are closing in the provinces, and quite often it's older populations who now don't have access to a physical branch. But these are also the people who are sitting on the wrong side of the digital divide. So it's a double whammy in terms of losing access to not only community services, but basic financial services. Yes, the digital divide is real, and with FinTech, and the changes that we're seeing in terms of aggregation and concentration of branch networks and retail networks, we are going to see parts of the community being marginalized and lose access. So this is where the complexity becomes even greater, that when we're talking about access to financial services, we're not only talking about the financial network or the financial industry, we're also talking about our broadband infrastructure, we're talking about the uptake, the digital literacy. And is it within the gambit of central banks to do that? Surely not. And we know that government departments don't work with each other, right? Cooperation for anybody is difficult, and government departments in particular, because they're very siloed in their makeup, do find it difficult. So these are going to be some of the big challenges we find, that technology is actually busting down some of the barriers, the creep of industries meshing together, and exclusion across different channels means that the solutions will also be across different channels and makes it more difficult to...
The digital divide has been enhanced by urbanization, the difficulties you face with so many different communities spread over such a large archipelago.
In the case of the Philippines, actually the technology wave has gone faster, meaning everyone has at least one, maybe two, and some 4 cell phones, even in the far-flung provinces. Even in the 33% of the archipelago that do not have banks, everyone has a cell phone. So it's not a question right now of a digital divide. It's really a question of how they use the technology in terms of the products and services.
And therefore it's an educational question.
And that's where the education comes in.
Of course, there are 1 billion Indians with the biometric profiles, as Mr. Mundra was telling us as well. You know, this is inexorable, this change. I want to open it up to the floor, so I'm going to take questions any moment, so if anyone has them, please raise your hands, and the team are moving around with microphones. But Cheryl, you were going to say something in the meantime.
Just the one point I want to make is that I believe it would be a mistake if we left the impression that it is only the FinTech firms that's driving this. It is being driven by consumers, and it's being driven by consumers across all socioeconomic backgrounds. To Johnny, your point about the number of consumers in the Philippines with cell phones. So it is being driven both by the fintech industry as well as consumers, and that creates a different kind of pressure on the regulator.
We have a question just over here.
Yeah.
Oh, hi, thanks very much. Sue Lewis, UK. It's sort of part an observation, really. We've got a huge fintech industry in the UK, and one of the things we're concerned about is that what that gives the opportunity is for much better risk profiling, both for insurance and credit. So we'll get a new set of people who are excluded, excuse me, but more than that, you get a demutualization of risk, which is a policy issue. It's not just a regulatory issue, because there will be some people who are excluded by virtue of their risk profile who wouldn't currently be excluded, or they'll be priced out of credit and insurance markets. And I just wondered if the panel had thought about those things within their context.
That goes to the realm of managing big data. Yes, there are a lot of people, at least for our side, there are people in the central bank that take a peek, and try to figure out what the risk profile looks like. My sense of it is that the risks are not going to change much. My sense of it is the delivery, the management, mitigation of the risks might change depending on the technology that we so use. So again, there is no debating that technology is the way forward. My only point is that there has to be a certain pace to it, because people can only absorb so much.
In the U.S., Sue, thank you very much for your question, and we actually we watch very closely what's happening in the UK as it relates to fintech, the regulation of fintech companies. In the US, we have what we call a protected class of individuals. So when we look at any kind of financial product or service, or for that matter, any kind of social benefit, that class remains unchanged. It's based on ethnicity, it's based on gender, it's based on religion. So across all policy perspectives, that social class exists, and we pay very close attention to see whether there are any kind of inherent biases against those individuals.
Just one minor point. We know that some digital banks are using credit scores based on big data. We know that they will be more and more in use because it's very quick information that they can allow them, obviously, for those credits being granted after finger touch. In Europe, I would like to share also with you that at the supervisory authorities, we are discussing big data impact in terms of consumer protection. And we are also discussing a lot the commercial use of consumers' data. This is a priority for the European supervisory authorities. We are discussing that in order to try to, obviously not to prevent the use of this information, but at the same time to protect consumers and to allow them to know that they are facing those risks.
To acknowledge their privacy concerns.
Yeah.
Right.
Very
Thank
important.
you. We are over time, but we just have kind of one quick question.
New Zealand Federation of Family Budgeting Services. We're quite concerned about the opening of the digital divide in terms of access to internet, because the gentleman from the Philippines said that everyone has a cell phone, but not everybody actually has a data plan that goes with that. So many of our people that are in the lower socioeconomic groups are actually having to access the internet through public Wi-Fi networks. And we're very concerned that in the fintech space, that opens their financial activities up to very insecure locations and predatory behaviour. And we're wondering what the regulatory bodies are actually looking at and doing in this space to make sure that if you have to access financial information in a public Wi-Fi space, what is your protection in terms of consumer rights?
Thank you. Very quickly.
That goes to the perimeter wall. Whose remit would it be in terms of a technology platform that does what looks like a financial service, but is not being done by a bank? Unfortunately for us, the legal mandate defines what a bank is, and therefore there's quite a bit of gray area. I would wish to have Maria's leeway, actually, because that solves my
Have a
problem.
large scope. Let me add that, as I said before, and you all know that FinTech brings new risks for consumers, although lots of advantages and so on and so forth. I think at the top of those risks, security should be the first one. It's why we started FinConnect with security risk. And coming back to what my colleague said before, I think there is a need for a strong cooperation among different authorities. Prudential supervisory authorities, conduct of business authorities, payment overseers, judicial authorities, and depending on the national framework with the government entities, there is a need for cooperation. This is very comprehensive. This is going to be very difficult. We need to put all of us together facing these risks we have in front of us.
All right. Thank you all very much. Ladies and gentlemen, would you please show your appreciation for the panel? Plenty of food for thought. Thank you all very much. Cheers, much appreciated.